I'm Sam Slater from Chelsea, and I've been joined today by Mark Swain, manager of Smith Williamson Enterprise Fund. Hi, Mark.
Yeah, hi there.
So, this fund can short stocks, which basically means making money out of falling share prices as well as rising share prices. That must have been particularly useful during February and March when stock markets around the world fell so dramatically. How were you positioned then, and how did that help you mitigate some of those stock market falls?
Yeah, obviously the shorts, were very profitable in this period, helping offset, losses on the long side. How we positioned, we were pretty cautious coming into March. Our concerns were that we'd had the longest bull run in market history, and hedge funds were pretty aggressively positioned coming into this as well. High nets, high grosses. This was a risk that we were concerned about. So we were pretty cautious coming into this, having a low net, and those shorts in the most cyclical names and the most indebted were highly profitable. They were the ones that got hit the hardest.
So when you say net position, that basically means you had more short positions than long positions at that time, or?
Yeah, it's a reminder that our gross position is our longs plus our shorts, whereas our net position is our longs minus our shorts. So if you have a low net, you effectively have as many shorts as you do longs, and that you become more market neutral, less dependent on the market going up. If you have a very high net, you're more exposed to the market, therefore you're slightly more reliant on it going up to make money.
And now that we've maybe seen at least one bottom, there may be more, who knows, but are you finding more opportunities on the short side in that you think share prices are going to fall further, or are you finding more opportunities to invest in companies for the long term now?
A bit of both, really. I mean, the market has had a decent rally from the bottom. It's up circa 14%. And what this means really is that we think some stocks have been overdone. They've rallied too far, painting an overly optimistic scenario, and so we're still finding plenty of companies to short because we think they look overvalued. But on the flip side, a lot of companies still look very oversold. I mean, I think a good example is take two cyclical sectors like house building and the capital goods sector. They're both 40% off their highs, and yet most of the house builders are sat on a lot of cash. And it's probably going to be one of the sectors that comes back the earliest in terms of construction workers getting back to work. Whereas the capital goods sector, there's a lot of debt in that sector, and a lot of it is exposed to oil as well. And obviously, $20 oil is pretty unhelpful.
And how does this compare to other bear markets? I mean, we've seen bond prices have fallen pretty dramatically as well as equity prices. Some things have not been as uncorrelated as you might have expected. Has shorting actually worked in this environment still?
No, the shorts have worked very well. It's not the shorts that are the problem. But when you say, how does it compare to other bear markets? I mean, the only playbook we really have is 2008 and the global financial crisis. The difference, however, is that was death by 1,000 cuts. I mean, the UK equity market fell 30% over the year, while this time around it's fallen 30% in 3 weeks. And for the first time ever, companies and analysts are having to forecast a zero for a month or maybe a quarter, which is unprecedented. I think, where we look at it versus other bear markets, I think the market is currently pricing in a V-shaped recovery, which I personally think is overly optimistic. I think the extent of this lockdown is going to go deeper than that, and I think the shape of this recovery is going to be more like a U-shape, personally.
And with that in mind, what kind of changes have you made to the portfolio in the past few weeks, if any?
Well, given the scale of the falls and the volatility in March, our key focus became capital protection. And the only way you can really protect capital in those volatile markets is to de-risk the portfolio by reducing position sizes and effectively taking money off the table. So we did that in the middle of March, and then waited for the dust to settle. During that sort of de-risking process, we sold some of our most cyclical longs, and our most, what we perceive to be crowded, where a lot of people are active. And then at the start of April, once the dust had settled and it felt like the market had found a bit of a bottom, we started to put that risk back on the table by increasing position sizes. But we also added we added a number of short positions. The earnings number is very difficult to forecast with any certainty at the moment, coming back to that zero sales figure for a lot of companies. So our focus really turned to balance sheets, and we introduced some new shorts in the most structurally challenged companies with a very weak balance sheet. The shocks like this will highlight the strongest and the weakest players, and a weak balance sheet leaves companies in a very precarious position right now.
So one of our investors actually asked us a question about shorting, and do you have to report your shorts to the regulator when you make them? Is that correct?
Yeah, so there's something called transaction reporting, which is you have to report any transaction, whether it's a short or not. But you have to make the additional reporting requirements for shorts is the public and private disclosable positions, and that depends on what percentage of the issued share capital you are short of. So if you are short of over 0.2% of issued share capital, you have to make a private disclosure to the regulator. And if you are short of over 0.5% of the issued share capital, you have to make a public disclosure. So if you look up on Bloomberg or Short Interest Tracker, which is a publicly available website, you can see the publicly disclosed short positions, which is everyone that has a position over 0.5. Now, there are some intricacies over and above that because the privately disclosed short positions aren't publicly disclosed, the publicly disclosable position isn't big as the whole short position, if that makes sense. And there is a rule of thumb that if you look up a short position and it says the publicly disclosable position is 5%, the overall position is likely to be nearer 10%.
That's great, thank you. And if you'd like to find out more about the Smith Williamson Enterprise Fund, please go to chelseafs.co.uk.